Let me just start with the conundrum of these low interest rates. Is your attention on the nominal, the current rate, or are you focused on real yields?
Absolutely real yields, because that ties into financial conditions, and that is what central banks don't want to tell you, but what they're actually doing with yield curve control is depressing nominal, get inflation up, get inflation to escape velocity, and depress real yields, because that's the real thing, pardon the pun, which helps corporates.
So, Jeff, that's the objective right now in the United States. You think yield curve control is happening, whether they formalize it and announce it or not?
So, in effect, I think that's what the market's pricing in. And as you say, if a central bank doesn't announce it, but if you keep markets believing for long enough and such that it's effectively priced in, then the central banks in general, not just in the US, but elsewhere in the UK here, I think they'll just clap their hands and say, job well done. It's always about expectations. If they can get longer dated inflation expectations up, then it's a job done. But that's the missing piece of the puzzle right now. Nominal, not moving, inflation, even less.
Do you think they can, Jeff?
So now this debate about whether they want to start to target average inflation, not just spot inflation, but inflation over a period, I don't think we're there yet. They can, when they start to say, we really want inflation to fly over a 5-year horizon. If your starting point is 1, then for the sake of argument, it doesn't matter that your end point is 4 or 5, as long as you average out to be 2 or 3. You need something like that enshrined in a remit. So the Fed's monetary policy review is coming up. UK, they're reviewing this, all the time. Once that is enshrined, then markets may begin to believe it, but we're not there yet.
Jeff, I want to talk about the reaction function from the Federal Reserve monetary policy setting, going to purchase some of these longer-dated bonds as the U.S. Treasury announces a near $1 trillion borrowing plan in the next 3 months. Is this basically plunge protection control? Is this basically the Fed that's going to prop up asset prices indefinitely until you get some rip-roaring inflation, which isn't on the horizon, and it's not a matter of any kind of bleed-through to the underlying economy at this point?
Well, I don't think any central bank will actively admit that, but they do know if you do get a market sell-off, if you do get bond sell-off, equity selling off, that is a tightening in financial conditions. Now, in reality, the economy, if it's growing fast enough, might be able to withstand that hit, but no central bank, wants to take the chance right now, so they'll just keep going until we get to escape velocity. But the RBA decided, I know they once said, so they're in yield curve control already, as are the Japanese. They might start to say, we're controlling a part of the curve we're comfortable with, but if the very long end, that starts to steepen due to inflation being priced in, they're okay with that. But they have a set target right now, and they're absolutely going to stick to it with asset purchases.
Right now, the real rates on 10-year is a negative 1.05%. What's the breaking point here?
So the breaking point, again, is when there are 2 ways to think about this. One, is it a breaking point to the downside, whereby you fall into a Japan-like scenario where no matter how low you depress real rates, it's just not going to work due to demographics, due to productivity. Then the markets just say we might as well go home, get out of equities, just stay in cash. There's no difference. Or there's going to be a loss of control, a loss of credibility, upside inflation risk. But I think right now central banks are more worried about downside disinflation, deflation. That word is still forbidden for them.
Yeah, but to Lisa's brilliant question, Geoff Yu, we're doing yield curve control sort of kind of like, and then you just correctly stated they're worried about disinflation and downside moves. What do you see in the 10-year tips when you see that? I see convexity and some form of gentle acceleration to a Japan-like very low real yield.
Well, that is something that central banks will just have to try to manage as tightly as possible. What is their tolerance threshold? You look at the 5-year break-evens right now; it's falling again. It's below 150. So, do you want to contain that to make sure it doesn't just soar as a sign that central bank is doing that the central banks are being too effective, or do you just want to keep it in a range right now? The trajectory matters. We've gone from effectively 0 in March down to 1.5. They're happy to keep that pace. Even if it goes to 2, they're happy with the pace. But if it suddenly just expands exponentially, then that's the loss of control, loss of credibility we talked about. The risk is always you don't know you've lost control, lost credibility until you actually lose it. And I think that's a risk that all central banks will have to take right now.
Well, Jeff, let's get to what that means in the FX market, the relative story of a currency pair with the US dollar on the one side. How would you push this through G10 right now?
Well, so right now in G10, irrespective of what the RBA said overnight, I'm still very comfortable owning Aussie. Aussie is the best reflation play right now. They've got some China tailwinds in terms of the iron ore market. Property is reflating there, and in terms of trades are improving. Elsewhere, euro, we're comfortable adding to euro longs, even if we get a bit of a short-term correction. I am a bit more concerned about the ECB being worried about disinflation due to strong euro, but overall, it's more and more clients are asking about the dollar debasement narrative. Are we seeing a shift? Is China going to push for a second win for renminbi internationalization? That, as a structural story, is going to be really, really interesting to see.
Okay,
but
Jeff,
for now, euro and Aussie.
Two stories here. This is really, really important. If someone says to me they like the Aussie, they like the euro, I'm thinking they think we're going to get a pickup in cyclical growth, a return to risk appetite. But when they say we're talking to clients about dollar debasement, there's something else happening there. Which one is it, Jeff?
One is the short-term cyclical uptick. If Europe and Australia get their COVID reaction functions right with government investment, and you're seeing that in Europe and Australia, then that's a cyclical upturn. For the dollar story, and it's also a renminbi, a euro, what is the future for reserve currencies? What is the future for currencies full stop in this new policy paradigm that we have? Then will the dollar's relationships to risk, to cash, to everything else, will that start to change? You've got the 1-year story versus the 10, 20-year story.
Jeff, I can't let you go without nailing you on this. Did you ever think that we'd be talking about the loss of reserve currency status with the dollar index in the 90s?
So it's not about full loss of reserve status, it's loss of dominance. The US dollar will always be a reserve currency, but will it always be 60, 70%, 90%, so dominant in terms of payments, 45% of FX transactions? Those numbers, they plateaued a long time ago. The only direction is probably lower. But is that a 1-year story or a 10-year story? Let's look at the policy mix.